Hello everyone, I'm Yazan Ibrahim, or as some of you might know me, Yazan Abu Ghosh. Today we're going to dive into a fascinating and essential topic, Fraud Examiners Section 1, Financial Transactions and Fraud Schemes. 1.1 Accounting Concepts, Accounting Basics and Financial Statements, and at the end, Generally Accepted Accounting Principles. Welcome to today's deep dive into the world of accounting, where we'll explore the fundamental concepts that underpin financial transactions and the systems used to record, summarize, and analyze them. Whether you're an aspiring fraud investigator, a business owner, or simply curious about how organizations manage their finances, or if you are auditor, this journey will shed light on the often complex systems that drive decision making. The foundation of accounting, the equation that balances it all.
At the heart of accounting lies a simple yet powerful equation. Assets equal liabilities plus owner's equity. Let's break this down. Think of assets as everything your business owns: cash, tools, inventory, or even patents. These are the resources that fuel operations and opportunities. But assets often come with obligations, and that's where liabilities enter the picture. Liabilities represent what the business owes, whether it's a bank loan, unpaid bills, or long-term debt. Lastly, we have owner's equity. This is the owner's stake in the company, essentially what's left after you subtract liabilities from assets. It's the synthesis of the initial investments made by owners combined with the retained earnings or profits kept within the business year after year. This equation, developed centuries ago by Luca Pacioli in 1494, has remained the cornerstone of double-entry bookkeeping. What makes it so enduring? Balance. No matter what financial event occurs, collecting cash from a customer, borrowing money, or purchasing equipment, the equation always balances. Consider this example. If a company takes a $10,000 loan, it receives $10,000 in cash, an asset, and simultaneously records a $10,000 liability as notes payable. Assets and liabilities both increase equally, maintaining equilibrium in the accounting equation. Debits, credits, and the art of transactions. Accounting's elegance lies in the interplay between debits and credits. Imagine each account as a T, with debits on one side and credits on the other. While it might sound technical, it's really just categorization. Debits increase assets and expenses, whereas they decrease liabilities, owner's equity, and revenue. Conversely, credits increase liabilities, owner's equity, and revenue while decreasing assets and expenses.
For example, let's say a fraud examiner finds a $5,000 debit recorded as a legal expense and a corresponding credit to cash. There's no legitimate documentation for this legal expense. This discrepancy could alert the investigator to a potential attempt to conceal theft by disguising it as a business cost, a classic case of fraudulent accounting. Each accounting transaction involves equal debit and credit entries, which is why it's called double entry accounting. This meticulous balancing act ensures that the accounting equation remains accurate and the records are reliable. How transactions flow, from invoices to statements. To understand accounting's big picture, we need to follow the journey of transactions through the accounting cycle. It all starts with source documents like invoices, receipts, or checks. These documents form the basis for journal entries, chronological records that capture the nitty-gritty of transactions. Journal entries then lead to general ledger accounts, where individual accounts, such as cash, sales, or rent expenses, are updated. Finally, the information flows into financial statements, the summarized reports used by stakeholders to make informed decisions. Let's think of this process as a story. Picture a company purchasing raw materials. First, the purchase order acts as the source document. It gets translated into a journal entry, debiting inventory and crediting accounts payable. Then, that entry feeds into the general ledger under the respective accounts. By the end of the accounting period, it all comes together in the financial statements, revealing the business's final financial position. Cash versus accrual, when timing matters. One critical distinction in accounting methods is cash-basis accounting versus accrual-basis accounting. The cash method is straightforward. Transactions are only recorded when cash changes hands. This means if a customer pays later, the sale isn't recorded.
until the cash is received. Similarly, if you prepay for a service, the expense is recorded immediately, regardless of when the service is actually provided. Accrual accounting, however, is about matching. Revenues are recorded when earned, and expenses are recorded when incurred, aligning costs with revenues for more accuracy. This is why it's the foundation of generally accepted accounting principles, GAAP. Imagine you hire contractors, but they don't receive payment until next month. Under accrual accounting, you still record their wages as an expense in the month they completed the work. This approach provides a clearer picture of a company's true financial health. Understanding financial statements, the Big Four reports. The culmination of the accounting process is the preparation of financial statements. These documents are the lens through which we view a company's performance. There are four main types. 1. Balance sheet provides a snapshot of the company's financial position at a specific point in time, detailing assets, liabilities, and owner's equity. It's essentially an expanded view of the accounting equation. 2. Income statement, also known as the profit and loss statement. This report tells the story of the company's profitability over a period, tracking revenues and expenses to reveal the net income or loss for that time. 3. Statement of cash flows. Unlike the income statement, which includes non-cash items, this statement focuses on cash inflows and outflows, providing insights into how the company is generating and using cash. It's a vital tool for understanding liquidity. 4. Statement of changes in owner's equity. Details changes in the equity account, such as contributions, earnings retained in the company, or dividends paid out. For a fraud investigator, these financial statements act as a map. Reviewing them can uncover patterns, irregularities, or areas where further scrutiny may be needed.
For a fraud investigator, these financial statements act as a map. Reviewing them can uncover patterns, irregularities, or areas where further scrutiny may be needed. For instance, unexplained adjustments to retained earnings may indicate an attempt to obscure fraudulent transactions. The power of accounting in fraud detection. By now, you can see how accounting isn't just about numbers. It's an intricate system designed to tell a story about a business's financial health. For fraud examiners, understanding this system is essential. It's not just about crunching numbers, it's about analyzing patterns, understanding potential weaknesses, and identifying inconsistencies. So, whether you're a fraud examiner unraveling concealed theft, a business owner managing financials, or someone who wants to understand how companies operate, mastering the foundations of accounting opens doors to deeper insights and better decision making. And that's the magic of accounting. It turns chaos into clarity, translating complex financial webs into actionable, understandable knowledge. With this understanding, you're better equipped to navigate the financial landscapes of today's world. Thank you for joining me on this journey. Let me know what other topics you'd like to explore, and as always, keep learning. Thank you for watching, and as always, continue learning. Stay curious, and we'll see you next video.